Welcome back. We of course are trying to get an assessment of where we stand, right? There's efforts by the government to boost consumption, but that 50% tariff from the US, of course, remains a big overhang. Who better than Sajjid Chinoy to take us through the thinking and how should we think about this in terms of impact to the economy? Head of Asia Economic Research at JPMorgan. Sajjid, good morning. Great to have you with us here. Thank you very much for joining us, and sorry to have kept you waiting. So first cut, Sajjid, how are you thinking about this 50% tariff hit? It's almost like a trade embargo for most products out of India to the US. While one hopes that this is not, obviously this is not permanent, and perhaps the 25 gets knocked off after some negotiation or something is worked out, but for now it's there. Go on, Sajjid.
Morning, Prashant. Great to be here. I think where you ended was the key here. That there are two issues about permanency, whether we're at 25 or 50 for the foreseeable future. At 25%, even though we're higher than our competitors in Asia, we're in the ballpark, and there are other measures you can use to remain competitive and keep your market share alive in the US. At 50%, we're at a distinct disadvantage. And the math here, there's about 2.3% of GDP of India's exports to the US. A quarter of that is exempt, in terms of electronics, pharmaceuticals. So there's about 1.7% of GDP that's exposed. But what matters really is the value addition, because many of these sectors, gems and jewelry, have large import content. And the value addition here is about 1.1%. So there's 1% of GDP that's at risk facing the US. Now, I think the couple of important points to make here. One is that even though this 1% of GDP may sound like a small number in the grand scheme of things, as you know, this is concentrated largely in labor-intensive sectors, right? So it's textiles, gems and jewelry, leather, footwear. And so from my perspective, if you're presuming that this is a temporary shock and lasts a few weeks or a few months and not beyond that, the key is to avoid non-linearities, by which I mean the key is to ensure that, economic enterprises in those labor-intensive sectors stay alive, and there are no job losses there. Once you get into job losses, then you get down a spiral in terms of knock-on effects on consumption that are harder to reverse. Now, the good news is we have a playbook from COVID. This is exactly what happened in COVID, where, one fine day, there was a sudden demand shutdown. And the question around the world was, how do you keep economic enterprises alive? And India has utilized a lot of those tools. And I suspect a lot of those COVID tools will come back, by which I mean, targeted support, both from monetary and fiscal. On the monetary front, it's more about liquidity, it's about regulatory forbearance. And from the fiscal perspective, it's actually more specific fiscal packages for certain sectors. The good news is technology allows you to target these sectors and firms very precisely, because these are all exporting sectors and therefore go through the banking system. So we can target them very precisely. And so I think that's the first order of business. Before we talk about a counter-cyclical response in terms of GST cuts and monetary policy, the first order of business is, over the next few weeks and months, presuming this is a temporary shock, how do you deploy those COVID-era tools to keep these economic enterprises alive and ensure that there are no job losses?
How much?
Sajjid, just to get the numbers out of the way, so 25% India can compete, 50% complete, of course, it's an embargo. 1% of GDP is at risk, but you're saying that 1% is large because the indirect effect is much larger. And you're saying once you get into the cycle of job losses, etc., it becomes much more harder to contain. So immediately urgent sector-wise COVID-like support measures are necessary, right? Over the next few weeks.
That's right, Prashant. I would say days and weeks. And I say this because this is one of those shocks where the costs will, if this gets over in a month's time, that would be a demand shock that we can easily absorb. The longer the shock proceeds, my worry is the more the costs build, because the initial shock is a loss of demand. The secondary shock becomes the hit to employment, and then the knock-on effect to subsequent consumption losses because of employment losses. And then the tertiary shock is the longer this continues, that animal spirits, investment, China plus one gets impacted. Now, I'm hopeful, however, that this will not be a very long shock. The good news about US capriciousness is that we've seen this movie before with many other countries where standards have changed over time, and one fine day the US is amenable to striking a deal. So I think the key is, while we are undertaking these mitigation measures, we have to continue talking to the US, keep negotiating in good faith, and hope that eventually wiser counsel prevails on their end.
We take that point entirely. Sajjid, just a two-part question here. One, immediately, what, in your assessment, could be the amount that should be deployed to support these sectors? How much would it cost the government? And then to the second point, you said, boosting methods of boosting consumption. The government has already foregone some amount on account of the income tax cuts that have come by. Then there are the PLI schemes, all those measures to increase, growth out there, losing some of the government revenue. And then there are the GST cuts as well. All in all, the question is, how much would it cost the fisc?
And it's, these are very early days because it's not clear how long the shock is going to last. The longer it lasts, the more it will cost. I think the good news is, because we've got a playbook that we've just used in COVID a few years ago, and given, the tremendous advances India has made on technology and the ability to target, enterprises and certain sectors, this needs to be, I think, a very targeted response, right? And because we can identify which sectors, which exporters. And I think the other element to consider here is that while this is 1% of GDP, the sectors that we're speaking about, the US constitutes a large market share in those sectors. And so I think ensuring that, these firms and sectors remain viable is the key. I think the fiscal costs, too early to estimate what they are, but I'll make a larger point. I think even if it costs the exchequer something in the near term, in the long run, this will more than pay itself back. Because if you're preserving the viability of enterprises, preserving employment, preserving consumption, that will more than pay itself back. Now, you raise a more important issue, which is, if you step back, this is a year where we'll have to manage the fiscal carefully. And for no other reason, because, we'll get a GDP number today, which should be relatively strong, fingers crossed, close to, 7% almost. But nominal GDP today, I think, will be an equally important story. And nominal GDP is expected to soften to about 8% today. You could have a year where the WPI deflator is so soft that nominal GDP this year could be 8% or below 8%. Now, with that kind of nominal GDP, tax collections will need to be realistically assessed. It's hard to get 12, 13, 14% growth in taxes if nominal GDP is at 8%. The good news is we have some buffer from non-tax revenues, but we have to manage the fiscal carefully this year for these three reasons. A, you've got softer nominal GDP. B, you require some targeted fiscal support for sectors under stress. And C, you've got a GST tax cut. Now, the key there again is going to be how much of that is revenue neutral.
Absolutely. And I was just coming to that point, Sajjid, to sort of cap it off. I mean, we can't control what the Americans are doing. All we can control is what we are doing, right? So you're saying more targeted measures. So if you could give us some sense of what is the fiscal space for what size of a package of measures for these sectors, A, and B, this GST cut. I was just asking the previous set of guests. Now, the estimates are that the revenue implication could be as much as 1 lakh crore, the revenue loss. It's not going to be revenue neutral. So then again, how does one do the whole balancing act and the adjustment? And will this extra spend, if I could call it, it's a revenue loss, let's just consider it spend, will it do the job of actually spurring the local economy, local level consumption here?
Yeah, that's a great question there. I think let's wait and see. I don't want to presuppose what the GST Council is going to say on September 4th and 5th. I think let's step back. Before we talk about revenue losses, the fact that we're reforming the GST, simplifying it, make compliance easier, is a hugely important structural reform. So I think that's the bigger picture here, right? That you're going from 4 slabs to 2 slabs. If you make compliance easier, I think over the long term, this is unambiguously positive. Now, we need to be a little bit careful about, what the revenue losses are, because this is not temporary support, right? That once you reform the GST, again, another reason to do that is because the ratio of indirect taxes to direct taxes in India are very high. Indirect taxes tend to be regressive at a time when consumption needs support. Bringing indirect taxes down and reducing the cost of consumption, again, necessary, warranted. But I'm just being a little bit careful from the medium-term perspective, because, if nominal GDP is going to be lower, then stabilizing debt means you have to bring fiscal deficits down. And the GST tax cut, as important as it is structurally, if there's a very large revenue loss, it's not a one-time effect, it's a permanent effect over the years. So we need to balance both these considerations. How much stimulus should you inject in the economy in a year like this? But how do you preserve fiscal sustainability in the medium term? I'm sure the GST Council will be thinking carefully about how to achieve this balancing act.
Absolutely. But I think the headline out of this interview, Sajjid, is, of course, this very impassioned plea that the government must act and must act now over the next few days and weeks to support sectors which are hit and avoid, the cycle of job losses and, of course, what comes out of that. But I think point very well taken. Sajjid, foreign flows have been very, very negative. Continue to be extremely, $4.5 billion in August. Big numbers, right? When in your conversation with clients, the dollar rupee is at a low. What is your sense on the fixed income rupee side? How are things looking?
I think clients don't worry about this for a couple of reasons. One is, yes, the capital account, has been volatile over the last year, FDI flows, debt flows, equity flows. But the fact is India's current account starting points are very benign. We have a year with current account, 0.6% of GDP in the year that just passed. Yes, there'll be some expansion if net exports get hit. If some of that 1% of GDP in value add gets impacted temporarily, the current account could widen. But the fact is that Reserve Bank of India is sitting on a war chest of reserves. So nobody worries about what the BOP implications are because there's plenty of ammunition and plenty of buffer. Two other quick points I'll make. I think given what's happening in the US, both cyclically and structurally, we're seeing the dollar weaken a lot. When the dollar weakens, it just takes the pressure off, emerging market currencies. If the Fed's going to be cutting, at least for the next couple of meetings, it'll provide relief to emerging markets. And thirdly, calibrated rupee depreciation in the next few months is not necessarily a bad thing. In a world in which, for example, our Asian neighbors have tariffs of 19 or 20%, and let's hope that, we claw it back to 25% or perhaps even lower. You want to get every percent of competitiveness that you can get. And so in a world in which the rupee is in a non-disruptive, gradual way depreciating, it's actually helping India's case on the export front. It serves to partially offset the impact of some of the tariffs. So I think, that's a policy choice that we will make, but really no reason to panic on, I think on macro, we can have a discussion on growth and jobs and consumption, but as we've discussed before, on macro fundamentals, when it comes to the current account, when it comes to inflation, when it comes to reserves, absolutely no concerns on India.
All right, that's great to hear. Sajjid, fantastic conversation, and I hope Mumbai is listening. I hope Delhi is listening as well. Thank you very much for being here with a very astute sort of observation and, of course, what needs to be done from here.